Is the AI hype train finally running out of steam, or is the smart money just quietly shifting gears? While tech giants report record-breaking profits, their stock prices are suddenly plunging, and a massive Nvidia delay rumor just sent shockwaves through Silicon Valley. If you're still mindlessly buying every chip stock in sight, you might be walking straight into a trap. Here is what's really happening behind the scenes of the market's biggest rotation. Samsung Electronics recently announced a staggering 19-fold surge in quarterly operating profit, reaching nearly 90 trillion won. While it beat expectations, its stock plummeted up to 10%. This stands in stark contrast to Micron, which saw a 15% jump after its results in late June. It's a clear sign that market sentiment is shifting rapidly. Investors have already priced in a flawless future, and the outlook for memory supply and demand remains highly volatile over the next few years. Adding fuel to the fire, semiconductor research firm SemiAnalysis dropped a bombshell on social media, reporting that Nvidia's flagship Kyber NVL144 rack architecture has been delayed by over a year, potentially pushing its launch to 2028. Tech sectors immediately faced heavy selling pressure. While it looks like a sudden shift in fundamentals, delays like this have been whispered about in Silicon Valley engineering circles for a while. The precision timing of this release, coming right at the start of July, when momentum stocks historically weaken, is highly strategic. Historically, the momentum factor averages a negative 5% return in July. After massive first-half gains in semiconductor and momentum ETFs, a crowded trade means risk comes from overextended positioning rather than fundamentals. For institutional investors, this unverified delay provides a perfect excuse to lock in profits or hedge without triggering regulatory flags for aggressive selling. Interestingly, this isn't a total AI bubble burst. Instead, capital is rotating into lagging tech giants like Alphabet, Microsoft, and Amazon, while undervalued software stocks are seeing inflows. As earnings season arrives, hints that tech giants might slow down AI capital expenditure could actually boost their stock prices. Meta recently surged 10% on news of leasing out excess compute power to improve returns. A slowdown in spending is great news for tech giants' cash flows, but it is disastrous for the hardware supply chain. The sell-off in AI hardware may just be starting. The most crowded trade of the first half of the year, long semiconductors, short hyperscalers, is reversing. On days when chip stocks plunged, Microsoft and Meta stood firm, or even rallied. AI infrastructure is still the massive story for years to come, but capital cannot stay at the top of the supply chain forever. Semiconductor companies were the pick and shovel sellers, enjoying an early boom. But now, as the market looks for who can truly monetize AI, money is flowing back to the tech giants who control the users, the data, the cloud platforms, and the distribution channels. The AI story isn't over. The mindless buying of any semiconductor stock is. As Tony Pasquariello, Goldman Sachs's head of hedge fund coverage, noted, AI capital expenditure is currently the single most important variable in the market, making the upcoming earnings season a massive test. He highlights two dimensions: the sheer scale of forward spending, which acts as rocket fuel for infrastructure providers, but stresses hyperscaler financials, and whether these cloud giants can prove their spending is resilient and linked to revenue growth. He believes investors have become overly pessimistic about these cloud giants, especially given the quality of their management and recent position trimming. Furthermore, Goldman Sachs analysis emphasizes that hyperscalers own the infrastructure, software, distribution, and customer relationships. They own the toll road, not just a car. Shifts toward open-weight models and intelligent routing will only drive more traffic to these massive platforms. They simply need to show they can modulate spending and turn the corner on free cash flow. Their moat lies in the entire infrastructure chain, not just a single AI model. Ultimately, the trend of buying semiconductors and shorting hyperscalers is reversing. In investing, no one gets it right every time, and the Nvidia news certainly caught many off guard. What truly matters isn't avoiding every single market shock, but practicing proper position management so you can stay rational during a hit, avoiding panic selling on the way down and reckless chasing on the way up.